Hey there, welcome back to Thrifty Finance Vision PH. Today we're diving deep into one of the safest and most reliable investments you can make, government bonds in the Philippines. Whether you're a seasoned investor or just starting, this video will give you all the information you need to get started with government bonds. We'll cover the basics, go through the different types, explain how to invest, and even take a look at the risks and rewards of these investments. So, stick around until the end, because you don't want to miss any part of this comprehensive guide. Let's start with the basics. What are government bonds? A government bond is essentially a loan that you, as an investor, give to the government. The government borrows money from you to fund infrastructure, social programs, and other public projects. In return, they promise to pay you back with interest over a specified period. Bonds are different from stocks because with bonds, you're not buying ownership in a company. Instead, you're lending money to the government, and the government guarantees to return your money with interest. This makes bonds generally safer than stocks. Bonds are considered low-risk investments because they are backed by the full faith and credit of the Philippine government. As long as the government exists and functions, you will get your money back. So, why does the government issue bonds in the first place? Think about it this way. The government has a lot of expenses. Building infrastructure like roads, bridges, schools, and hospitals, running social welfare programs, paying salaries of government employees, and even repaying previous debts. To finance all of these, the government needs a reliable source of funds. One of the ways it raises money is by issuing bonds. Essentially, the government is borrowing money from the public and promising to pay it back with interest. These bonds also help manage the country's national debt, allowing the government to refinance or pay down other obligations. Let's break down how government bonds actually work. When you buy a bond, you are lending money to the government for a specific period. In exchange, the government agrees to pay you a fixed interest rate at regular intervals, typically every 3 months. This interest is called the coupon. For example, if you buy a bond with a 5% coupon rate and the face value of the bond is 100,000 pesos, you'll receive 1,250 pesos every 3 months, which is 5% divided by 4, until the bond matures. Once the bond reaches its maturity date, the government will return the principal or face value of the bond. So in our example, you'll get your 100,000 pesos back at the end of the bond's term. Pretty straightforward, right? Now let's dive deeper into the different types of government bonds you can invest in here in the Philippines. Each type is designed to fit different investor needs, whether you're looking for short-term investments or long-term financial security. First up, we have Treasury bills or T-bills. T-bills are short-term securities, meaning they mature in less than a year. Typically, you can find T-bills with maturities of 91 days, 182 days, or 364 days. The cool thing about T-bills is that they are sold at a discount from their face value. You pay less than the face value when you buy them, but you get the full face value when they mature. For example, you might buy a 100,000 pesos T-bill for 98,000 pesos, but at maturity, the government will pay you 100,000 pesos. That 2,000 pesos difference is your profit. T-bills are great for investors looking for low-risk, short-term investments. They're also very liquid, meaning you can cash out fairly quickly if needed. Next, we have Treasury bonds or T-bonds. These are long-term bonds, typically with maturities ranging from 2 years up to 25 years. The main feature of T-bonds is that they pay fixed interest every 3 or 6 months. This makes them ideal for investors looking for a stable and predictable income stream over the long term. For example, if you buy a 10-year T-bond with a 4% coupon rate, the government will pay you 4% of the face value of the bond every year, divided into 2 payments. If your bond is worth 1 million pesos, that means you'll receive 20,000 pesos every 6 months. Now let's talk about Retail Treasury Bonds or RTBs. These are very similar to T-bonds, but with one big difference. They're designed specifically for retail investors. This means they have a low minimum investment, typically starting at 5,000 pesos. RTBs usually pay fixed interest every 3 months. RTBs are a fantastic option for everyday Filipinos who want to invest in safe, long-term securities without needing a large amount of capital. With RTBs, you can start building your investment portfolio with very little money. Here's a fun one. Premyo Bonds. Premyo Bonds are a special type of government bond that not only gives you regular interest payments, but also gives you a chance to win prizes. That's right. In addition to earning interest, when you buy Premyo Bonds, you're entered into raffles where you can win cash prizes and non-cash prizes like cars or even a house. The minimum investment is just 500 pesos, making it one of the most affordable ways to invest in government bonds. If you're someone who likes the idea of steady income and the thrill of winning, Premyo Bonds could be an interesting choice. And finally, we have dollar-denominated bonds. Dollar-denominated bonds are a way for investors to hedge against currency risk. These bonds are issued by the Philippine government but are denominated in US dollars instead of pesos. So, how do dollar-denominated bonds work? When you invest in these bonds, both the interest payments and the repayment of the principal are made in US dollars. This makes them an attractive option for those looking to protect their investments from the risk of the peso depreciating against the dollar. The interest rates on dollar-denominated bonds are usually competitive, but keep in mind that the initial investment and returns are subject to exchange rate fluctuations if you plan to convert your earnings back to pesos. For example, if the peso strengthens against the dollar when you cash out, you might get less in peso terms than expected, even if your bond performed well. On the other hand, if the peso weakens, you could end up with more pesos when converting your dollar-denominated earnings. Dollar-denominated bonds are ideal for investors who already hold US dollars and want to diversify their portfolios without the risk of currency depreciation. They can also be a good fit for OFWs or families who regularly receive remittances in dollars. Okay, now that we know the different types of government bonds, let's talk about how to invest in them. There are two primary ways to invest in government bonds in the Philippines: through the primary market and the secondary market. Let us explain how both work. The primary market is where the government issues new bonds through auctions. The Bureau of the Treasury conducts these auctions, and large financial institutions, called Government Securities Eligible Dealers, GSED, participate. These GSED are mainly banks and investment firms. Unfortunately, individual investors cannot directly participate in these auctions. However, once the bonds are issued, you can purchase them through GSED or banks that are authorized to sell them. The second way to invest in government bonds is through the secondary market. This is where bonds are bought and sold after they've been issued, and it's also where prices fluctuate based on market conditions. The Philippine Dealing and Exchange Corporation, PDX, operates the secondary market. If you buy bonds here, you can purchase them at current market prices, which might be higher or lower than the bond's face value, depending on factors like interest rates and demand. Now, how do you actually get started with buying bonds? First, you'll need to have an account with a GSED bank or a licensed broker. Banks like Land Bank, BPI, BDO, and Metrobank often offer government bonds to retail investors. You can simply visit your bank or access their online investment platform to check if they're offering bonds. Once you've opened an account, you can browse the available bonds, choose the type and term that fits your financial goals, and then place an order. It's similar to how you might invest in time deposits or stocks, but with lower risk because you're dealing with government securities. Did you know you can also invest in government bonds online or through mobile apps? The Philippine government has been modernizing its bond issuance process, and platforms like Bonds.ph make it super easy for retail investors to start investing. With Bonds.ph, you can start investing in bonds from as little as 5,000 pesos using your phone. The app lets you track your investments, see upcoming bond issuances, and even sell your bonds in the secondary market. All right, let's talk about the key benefits of investing in government bonds. Why should you consider them? First and foremost, government bonds are low-risk investments. They are backed by the Philippine government, which means that your principal is very safe compared to other investments like stocks or corporate bonds. In fact, government bonds are considered virtually risk-free because it's highly unlikely that the government will default on its obligations. So if you're a conservative investor who prioritizes capital preservation, bonds are a perfect fit. Next up is the predictable income that bonds offer. Unlike stocks, which can have volatile dividends, bonds pay you a fixed interest rate regularly, usually every 3 months. With bonds, you know exactly how much you're going to earn and when you're going to receive it. This makes bonds a great choice for people who want steady, reliable cash flow especially if you're nearing retirement or want to supplement your monthly income. Government bonds also provide a great way to diversify your portfolio. A well-balanced investment portfolio often includes a mix of assets like stocks, bonds, and cash. Since bonds are low risk and relatively stable, they can help reduce the overall risk of your portfolio, especially during times of market volatility. This is particularly useful if you also have more aggressive investments like stocks or real estate. Another great thing about government bonds, especially Retail Treasury Bonds and Premyo Bonds, is that they're very accessible to small investors. With a minimum investment of just 5,000 pesos or even 500 pesos, you don't need a huge amount of capital to get started. This makes bonds a fantastic entry point for new investors who want to get a feel for the financial markets without taking on a lot of risk. Of course, no investment is without risks, and government bonds are no exception. Let's go over the risks you should be aware of when investing in bonds. One of the biggest risks with bonds is inflation risk. If the rate of inflation rises above the interest rate on your bond, the real value of your investment, meaning your purchasing power, could decrease over time. For example, if you're earning 3% interest on your bond, but inflation is at 4%, you're actually losing purchasing power even though you're receiving interest payments. Another key risk is interest rate risk. Bond prices move inversely to interest rates. So when interest rates rise, the price of existing bonds falls. This means if you need to sell your bond before it matures, you could end up selling it at a loss. This is especially true for long-term bonds. The longer the maturity of the bond, the more sensitive it is to interest rate changes. Lastly, there's liquidity risk, which means that in certain market conditions, it might be harder to sell your bond quickly at a fair price, especially in the secondary market. While government bonds are generally more liquid than other types of securities, there's still a chance that in times of economic crisis, finding a buyer might take longer than expected. Another important consideration when investing in government bonds is taxation. In the Philippines, interest income from bonds is subject to a 20% withholding tax. This means that if your bond pays you 10,000 pesos in interest, 2,000 pesos will automatically be withheld for taxes, and you'll receive 8,000 pesos. Keep this in mind when calculating your returns. Now that we've covered the ins and outs of government bonds, you might be wondering, is this the right investment for me? Let's recap. If you're looking for safe, low-risk investments with steady income, government bonds are an excellent choice. They're perfect for conservative investors, retirees, or anyone looking to diversify their portfolio with reliable, government-backed securities. However, if you're aiming for higher returns and can handle more risk, you might want to explore other investment options like stocks or mutual funds. But in terms of security and peace of mind, it's hard to beat government bonds. That's a wrap for today's video. We hope this deep dive into government bonds in the Philippines helped you understand why these are such a solid investment option, especially if you're looking for safe and reliable returns. Don't forget to give this video a thumbs up if you found it useful. And if you're new here, subscribe to the channel for more in-depth financial content like this. Also, let us know in the comments if you're already investing in government bonds or if you're thinking about starting. We'd love to hear your thoughts. Until next time, keep learning and keep investing.